Hello people, this is Dr. Wang here recording. In this video clip, we are moving to Chapter 6, Parity Relationships. And in total, there are 6 parity relationships covered in this chapter, and we are going through the first 3 of them, which are called interest rate parity, purchasing power parity, and international Fisher effects. The other 3 parity relationships will be derived based on the first 3. So in Chapter 5, we have learned covered interest arbitrage, and that is a whole idea developed from interest rate parity. And parity stands for equilibrium, stands for equalization. So in the covered interest arbitrage, we would find opportunities if the interest of the 2 countries do not match each other, and there could be some arbitrage opportunity. But as people conduct more and more arbitrage, their profit would be gradually eaten up, and eventually the situation will be pushed into an equilibrium. And in that equilibrium, we will treat the investment in the US. Assume that you have $1 US and you invest your money in the US, you make the US interest. And on the other hand, you can use your $1 divided by the current spot rate, and then convert it into another currency to develop it in a foreign zone and make the interest in the foreign currency. And eventually, you are going to convert back your foreign principal and proceeds based on the forward rate, okay, which occurred in the future. So in the parity relationships, both sides equals. So $1 in US would be equivalent to $1 in the foreign country, and in that case there's no capital flows from either US to the foreign country or from the foreign country to US. So what about if this parity get violated? For example, what about if the left-hand side is greater than the right-hand side? In that case, then US becomes a better place for investment, and the Eurozone or the foreign place would become a not as good. So you make more money in the US than in the foreign country. Then the people will conduct a covered interest arbitrage. So it's the money will flow from the foreign country to the US. And in that case, this would require them to borrow from the foreign country. And in this case, let me just use UK to represent a foreign country, all right? And then they will convert the British pound into US dollar at the current spot rate. And then they will invest in US, all right, and eventually the money will flow back to UK. So they will convert the dollar principal and interest back to British pound, and then the money goes back to their home country. Okay, so in this whole arbitrage, there are 4 markets they are dealing with. The Europeans are first need to borrow at the European financial market, the UK financial market in this case. So, and that is the interest they have to borrow at. And they also need to deal with the spot market. They also need to deal with the forward market. And also they need to deal with the US short-term investment market. We can call it US money market. That's what happens if the foreign country yields a higher return than US. And what about for American investors? Do they actually invest in the UK, in the foreign country? No, they don't, because the home already rewards their investment enough for them to not put their money overseas. Okay, and now let's talk about what would happen if this equilibrium got broken, if the left-hand side is indeed greater than the right-hand side. Then if you keep borrowing, then what would happen to the interest rate? Think about that. Borrowing is a demand of financial services, right? It's a demand of money. In your money and banking class or in your macroeconomics class, we know that interest is the price of money. We use money to express the price of other commodities, and the interest is the price of money. For example, if you buy a car, it's priced at like 20,000 US dollars. If you pay for your education, it's like a $600 credit per semester. Uh, so we use money to express all the other commodities, no matter goods or services. And in terms of money, we would use interest to express the money. So if we say it's very expensive to borrow, then that means we're paying high interest for the same amount of a loan we're borrowing. And if we say it's a free money, that basically means this loan has zero interest. It does not mean somebody is giving you money for gift for free. Free money means you are borrowing at 0% interest. You still just need to pay the principal. If you are looking at the money market, then you will need to look at the demand and supply of the money market. So this is the quantity, and this is the interest in percentage. And the interest, as I said, is the price of money, okay, or borrowing. Okay, so when you have a demand and a supply, you should know that if the demand keeps moving, that would affect your equilibrium in interest. And also with the supply moving, it could affect your equilibrium. In this case, let's say if we're at the UK money market, then if people just keep borrowing, that would create an extra demand of loans. So that would make your demand curve shift to the right. So that also means your demand increases. Okay, your demand increases. And what would happen to the newer equilibrium rate? So that's gonna push up the interest, so this would be your new interest. Okay, so eventually, if you keep borrowing from UK, then the interest rate in the UK would be up. Alrighty, so if you invest in the US market, so let me draw another diagram, demand and supply diagram for the US. What about if you keep investing in the US? You have the interest rate here as a percentage for the price and the quantity, and also demand and supply. If you keep lending, if you keep investing, it's the same as lending. All right, it's the same as lending. If you are lending, basically you are providing liquidity into the market. You are providing loans so people can borrow. And if there are more and more supply of loans, so what would happen to the loan interest? For example, if you just borrow from Wells Fargo Bank to finance your car, they're probably gonna charge you higher rate for their monopoly power. You go to Chase Bank, you go to Citigroup, you go to Bank of America to seek the best interest. So when you're looking at more suppliers, then the interest for you to borrow would be lower and lower as long as there's more and more competition of loan suppliers. With that being said, if there is more and more supply of loans, so when your supply increases, so this increases of supply would push down the interest. Okay, would push down the interest to a lower level. All right, so what would happen to the US interest? It would go down. Okay, and then let's talk about the spot market. If the arbitrageurs or the traders take advantage of this disequilibrium opportunity and try to profit from the situation, then they would keep converting pounds into US dollars in the spot market. If that happens, is that a demand or supply of a British pound? And what would happen to the interest rate of the pound? So let me just write things right here. In the spot market of a pound, and you should know that the pound price is expressed in US dollars, and the quantity is the horizontal axis, and there's a demand and there is a supply of a pound. So if you keep converting pounds to US dollar, then what will happen to pounds? It's the same as you sell pounds and buy US dollars. Since we are analyzing pounds, then we want to focus on the selling pound side of the story instead of a buying dollar side of the story, then selling pounds means you are supplying more pounds in the spot market. So if you keep selling and selling pounds in conversion of dollars, so that's more and more supply in the spot market. So your supply of pounds would increase. Okay, and the price is expressed in US dollars. So what would happen to the price of a pound? You will see due to higher supply, the price of pound would decrease to a newer level. So the spot rate of the pound would go down. Okay, the spot rate of the pound would go down just because people are supplying more pounds in the market. All right, and another market here we're analyzing is the forward market. It's a forward market. And what we will see that people are converting the dollar to pound in the forward market. And then what would happen to the forward rate of a British pound? Okay, if people convert dollar to pound, so that basically means they are buying pounds and simultaneously selling dollars. And we are interested in the price of a pound. So let me just draw this. This is for the forward market. Again, this is a dollar price per pound, and this is a quantity of a pound. And you have a demand and you have a supply. And these are both for pounds. If people are buying British pound, you are creating a demand of the pound. So that basically means your demand of a pound increases in the forward market, not in the spot market anymore. We're talking about an exchange in the future when the forward contract is due. So the result of increase of a demand would be the interest rate or the price of a pound reach to a higher level. So what would happen to the forward rate? It would increase. Okay, it would increase. So this is how we conduct the demand and supply analysis in the forward market. One is the money market in the UK. One is money market in the US. The spot market of a British pound. The forward market of a British pound. Okay, so what would be the result if you see the British interest goes up or the foreign exchange rate interest goes up? Okay, so this part is going up. So this part is going up. And the forward rate is also going up. What happened to the spot rate? The spot rate is going down. And what happened to the US interest is going down. So you will see in this disequilibrium, let me just rewrite it right here. If 1 plus US interest is greater than forward over spot times 1 plus the foreign exchange interest. If this is the case, then the people would conduct interest arbitrage, covered interest arbitrage, and would affect the rate in the forward markets. And eventually, the US interest would go down, forward rate would go up, spot rate go down, and the foreign interest would go up. So the left is going down, the right is going up. And eventually, this part goes down and this part goes up. And the final result is the two sides will converge, will be equalized to each other. Okay, so if there is any violation of the equilibrium, then there will be covered interest arbitrage, and then the forward rate will get affected, and then it will back to equilibrium. Okay, so this is how it goes. And I'm giving you another example here. So let's see, we have a opposite situation. So you have a US interest. The left-hand side is still US interest plus 1. So that's how much you can make at home. And the right-hand side is still forward over spot times 1 plus the, let's say, UK interest to represent a foreign country. So if the right-hand side is greater than this time, then what would happen? So that means $1 stay in the US would make a less return for you than $1 invested in the UK. Okay, so people will borrow from US and then invest in the UK for the higher return over there. So in the disequilibrium, there will be covered interest arbitrage. And in the arbitrage, people will borrow from US at the US interest. And the second, they will convert dollar to British pound at a spot rate. And the third, they will invest in the UK at UK interest, and then 6 months or a year later, when the forward is due, when the loan is due, they will convert the pound principal and interest back to dollar at forward rate. And in this case, what would happen to the US interest? If you keep borrowing, that means the demand is going up. Okay, demand is going up. So if you keep borrowing, demand is going up. Okay? And if you converting dollar to pounds, so that also means the demand of a pound is going up due to the arbitrage trading. Okay, demand of a pound would go up in the spot market. And if you keep investing in the UK market, that means the supply of loan in that country would increases. And if you keep converting pound to dollars with the forward contract, then that means the supply of pound would increase in the forward market, not spot market, in the forward market. So if the demand increases, you will see the US interest rate would increase. If the demand of pound increase, then the spot rate of pound would increases. And if the supply of loans in UK increases, that basically will result in a lower UK interest. And if you keep supplying more pound than in the forward market, then the pound rate would go down, okay? And this is a forward rate. So when all of these changes applied, then you will see that the US interest rate is going up. So the left-hand side gradually is moving up, and the forward rate is going down, the spot rate is going up, and the UK interest is going down. And jointly, this would make the right-hand side of the distribution to go down. So when the smaller part becomes larger, the larger part becomes smaller, then the both sides will converge to each other and reach back to equilibrium. Okay, so this follows the same process as I mentioned earlier. If there is a violation of the equilibrium, either the right-hand side gets greater or the left-hand side gets greater, then there will be covered interest arbitrage, and then this forward rates will get affected and eventually push back the situation to equilibrium. Okay, the reason people do arbitrage is because there is a profit involved from the violation of a equilibrium, aka disequilibrium. Okay. And if you keep trading more and more, then there's less and less profit opportunities until the profit becomes zero from the arbitrage, and this is a equilibrium situation again. Okay, so in the previous chapter, we learned how to conduct a covered interest arbitrage based on the situation and how to calculate the dollar proceeds or dollar profit from all the steps of a covered interest arbitrage. For more information, you can go back to chapter 5 and take a look at the module there, and especially the topic on this interest arbitrage. There's also uncovered interest arbitrage, which I will not spend much time to cover. You just need to remember, if it is uncovered, some uncertainty involved, something you're not certain. In the covered interest arbitrage, you were dealing with the forward market, so you use the forward to lock in a exchange rate that will occur in the future. But if you don't use the forward, you are trading purely based on your expectation of the future spot rate. And this expectation can be wrong. And if the spot rate change unfavorably against your expectation, you would lose money. Okay, so instead of using forward trading, you use your expectation, then this would be called uncovered interest arbitrage. It's more risky. So I have covered all of this. You can just take a look at the PowerPoint, read through it, and also read through the chapter. And in chapter 5, I also have mentioned that this equilibrium could be rewritten after a series of algebra work. This equation could be converted to this. The interest rate difference is equal to the forward premium. It's still the same idea. So if the left-hand side is greater, then that means U.S. interest is relatively higher considering all the other situations. So that basically means you should invest, people should invest in the U.S. Either U.S. money stays home or the foreign money comes to U.S. If the right-hand side is greater, then that means people should invest in the foreign country. And that either means the foreign money stays home or U.S. money go to their country. And no matter which direction the international capital flows, the result is always the back to equilibrium. All the four rate here will change and eventually push back the disequilibrium to equilibrium. So this will be pushed back to equilibrium, and this will be pushed back to equilibrium. Why does that happen? Because no matter people invest in the US or invest in the foreign country, they will do covered interest arbitrage, and this would make the four factors to change. And then that would make it back to equilibrium. All right, and here let's talk about the interest rate parity line. In this chart, we have the interest between home and foreign country as a vertical axis. The horizontal axis is the forward premium. And you will see this 45-degree line as the interest rate parity line. That's when the interest differential equal to the forward premium. And there's some some points along this line like A, B, C, and D. That basically means these are equilibrium situation. And there are also some lines, some points that are deviated from this line. So that's the violation of the rate parity. So for example, you have a point Y here, and that basically is the interest rate differential is only 2%, whereas the forward premium is 4%. So the forward premium is too large, and the home country's interest is relatively too low. So that basically means the home money will go overseas seeking higher return from the forward premium and also higher interest from the foreign country. Okay, if that's the case, people will, the capital will keep flowing until it affects the four rates, the spot, forward, interest in the home, and interest in the foreign country, and eventually it will push back the point Y to the equilibrium. So the interest rate difference may increase from 2% to 3%, and also the forward premium will decrease from 4% to 3%, reach back to this equilibrium line. And that would also happen for point Z and for point X. And for point X, that also means the home interest is too low. You see home interest minus foreign interest is negative 3%, whereas the forward premium, this time is a discount, is negative 1, which is not as bad as negative 3. So this is the case still when the home money will go overseas seeking higher return, and that's going to push the forward discount lower, and then the home interest higher because people would keep borrowing from home sources. Then they will reach back to the equilibrium. And point Z would be different from point X and point Y. You see point Z lay above the rate line, and the point X and Y lay below the line. And point Z basically means your home interest is relatively too high. You see the home interest at point Z is negative 1%, and the forward discount is negative 3%. So home interest is good. It's better than the other factors. So the U.S. money will stay home. The foreign capital would flow to U.S. and that again affect all the rates and then eventually push back the deviate point back to the equilibrium line. So just need to remember any line above the interest rate parity line would be an indication of home interest is high, and any line below the interest parity line would be an indication that the home interest is too low. Relatively speaking, of course, we have to consider all the three factors, which are foreign interest, spot rate, and forward rate. Okay, so what is above the interest rate parity line? That's a zone for foreign investors to conduct covered interest arbitrage. They would invest their money in our home. And if it's below the line, then we will invest in foreign countries in our covered interest arbitrage. If it is around the line, so this is a equilibrium area. And here is one quiz, one practice question. Assume that U.S. investors are benefiting from covered interest arbitrage due to high interest rate on euro. So that means we are investing overseas and we are borrowing from U.S. and converting dollars to euro at spot rate and then invest in the eurozone. And then after the loan is due, we will convert back the euros to dollar based on the forward rate. And what would happen? So you can just lay out a equilibrium. So 1 plus U.S. interest against forward over spot times 1 plus the euro interest. Okay. So if a U.S. money going to the eurozone, that basically means the left-hand side is less than the right-hand side. Okay. Or the U.S. interest minus euro interest is less than the forward premium. So what will happen is people will conduct covered interest arbitrage, and this is a covered interest arbitrage. So what would happen is when people conduct covered interest arbitrage like this, U.S. money goes to the eurozone, it must come from this U.S. rate is relatively lower. Otherwise, our money will stay home. So what's the result of a covered interest arbitrage to the forward rate, spot rate, U.S. interest, and the euro interest? You can skip all this demand and supply analysis. You just need to know that the ultimate result would be this equilibrium disappear and the two sides eventually match each other. So in order for the two sides match each other, the smaller part has to be greater. This is a smaller part has to be greater. The larger part has to be smaller in order to reach the equilibrium. In order for that to happen, then the U.S. rate will increase. The left-hand side will need to be greater. Then the right-hand side needs to be smaller. So that basically requires the forward rate to go down, the spot rate to go up, the euro rate to go down. So the result in this question is U.S. rate is going up. So if you check the euro spot rate, it should go up. And then it's a downward pressure, so that's false. The euro forward rate should go down. This is a correct one. And U.S. interest should, in our analysis, U.S. interest should go up and the euro interest should go down. So the downward pressure on U.S. interest is false. There should be upward pressure and there should be a downward pressure on the euro interest. So C, D, both are false. A is false, so B is the correct one.